Joining us now on the desk is Hein Kruger from Kruger International, who's not only going to tell us about his stock picks, but also he was on a yachting expedition in the Mediterranean, so you can tell us a little bit about the Greek economy. Let's delve into PPC first. A company which has come under significant pressure, very much unloved because of the downward cycle within cement sales. We spoke off air, you said cement sales haven't recovered as yet, but it is one of the companies that you're looking at right now.
That's right. You know, every time the past 2 weeks when the market went down, it was the only green speck on the radar screen, and I wondered why, and it's probably because it can't go down further. It's really right at the bottom of the cycle, but remember, we're talking about a cycle here, and eventually it will go up. When, we don't know, but usually the stocks don't go up when the cycle goes up. It goes up before the cycle starts to go up, and we never know when that is, and you don't want to be caught with your pants down.
And let's assume that you get a reasonable recovery in construction and
yes.
cement and so on. Wouldn't you then want to be in a specific construction company, let's say Group 5 or Basil Reed on the Winelands route or something like that, where you might get more leverage? Why would you choose to be in a pure cement play versus an actual construction company when the cycle's recovering?
It's very true. I want to be there. But I start at the foundation, at the bottom, and that is where the cement starts. You do not know at this stage really which of the companies are already down at the bottom of the cycle. You know, they have their little blips, ups and downs and so on, and we've seen, for instance, a company like Murray & Roberts in the past. You know, they've been a couple of times in my lifetime on the stock exchange, they've been a top 40 share and a couple of times a small cap share. And but there's a couple of very nice shares there. You know, we like Stefanutti stocks, for instance. It's a very nice company to be in. But there's a couple, WBHO, you know, companies like that, Wilson Bailey. But we're not ready for them yet. So we start off with PPC, with a cement company. It is the oldest company on our stock exchange. It is the biggest. It's the biggest cement manufacturer on the continent. So they are really there.
What about overcapacity and old plants? Two of the big issues when it comes to PPC.
Yes, no, sure, that is true, but they are still they chugging on, they're chugging along. They are always there, and they're not short. The only thing that they might be short on will be maybe not enough capacity, but they will make money.
137 Rand 50, MTN. I'm sure you must be smiling today because it was
yes.
down 4.5%.
That's right.
Were you allocating money today?
Yes, it was. That was why I've actually put it on the radar screen. It was down because it went ex-div, and it was down 5%, and it was a nice day to quickly get in again because it's got a forward PE of 5.1%, and that is where you want to be. You know, it is a very safe way to realize which companies to buy. And that is to look at these big blue chip shares with nice dividend yields, and you know you're safe, and you're not going to be sorry in the end. And in the meantime, there's a nice little cash flow coming in, which you can allocate every time the market goes down in these volatile times.
And we were talking earlier on the show with regards to some of the small IT companies, and obviously there's a fair amount of risk around that type of share in a portfolio. At the moment, are you purposely sticking to larger cap companies that you perceive as being quality, offering value? What is your general approach to the market at the moment?
Yes, that is exactly what we are doing. We are sticking to the bigger companies with not necessarily all of them high dividend yields, because we will chat just now about Anglo-American, but to those companies where we feel that our risk is a little bit lower than with those smaller companies, because we are in the middle of this recession and we do not know exactly how long this thing is going to drag out and how long those companies with usually lesser reserves will be able to stick it out.
Let's touch on Anglo-American, because that's also one of your picks. And in fact, when you see how cheap some of these resource stocks are looking, even Sasol, why do you think the market hasn't re-rated them at this stage? Why are they looking so attractive? Because everyone I get on the desk saying they look attractive, we still haven't seen a significant movement.
Yes, we must remember it is very large cap stocks, and it actually takes something to move them. And every time people get a bit of a jitters, they dump some of those shares, especially your bigger shareholders, and especially the offshore guys who hold a lot of those shares. So when they dump South African stocks, those are the stocks that go, and those are the stocks that come down. And there are not necessarily people with enough cash around in the country that really want to jump into the market. And
I could paint an argument that says that financial companies, particularly banks, are also relatively cheap. They're well managed. Would you have banks in the portfolio? Is it something that you would be overweight now, or would you be still a little bit conservative?
No, I like to have a very diversified portfolio at the moment. I don't really go all out for one particular sector, but definitely, and that is why I actually called also today on Standard Bank again at the low 90s. It is always a good buy. And you know what, I was actually looking today at a long-term dividend graph compared to the price graph, and that is one of the companies where you just can see when the dividends are high and the price is low, you get in and you buy the share. Eventually you will make your money.
So, Hein, you look awfully relaxed. You were on a yacht in the Mediterranean, and
That's
I asked
right.
you earlier if you actually went on land in Greece, and you said it's the worst you've ever seen it. And I think a lot of viewers, and we've gotten these questions asked before, what is the Greek economy like right now? What is your sense?
Yeah. We sailed in the Ionian, in Kefalonia and those places, Lefkada, and it was wonderful. It was a wonderful time. A lot of yachties around. But I will tell you, in the 30 years that I've been visiting this time of the year, Greece, it is the worst that I've ever seen the tourism trade there. You know, when we went into the Plaka in Athens, usually you stand in queues to get into restaurants. You could pick and choose, and there were empty restaurants, and some of them didn't even have three to five tables, and then those were the full ones. And Eleni, the thing that really, you know, I was on the mainland and then I was on Crete as well. And the one thing that really struck me was thousands and thousands of miles of half-built abandoned highways, expensive stuff. Hundreds of half-built bridges like the Storms River Bridge. I mean, not small little bridges. Hundreds and hundreds of half-built tunnels through mountains. It is millions and billions of tons of concrete that went into that, and a lot of euros that are not Greek euros and that the Greeks have to repay. And I honestly cannot see that that economy can generate even the interest on that. So I'm terribly sorry. You know what? I remember someone told me some time ago that those 4 wind generators near Darling in the Western Cape was sponsored by the European Union. 4 of them, 70 million euros. There are, outside of every little village in Greece and on Crete, there are between 20 and 100 of those wind generators. They're not pumping on the economy, they're helping people to have lights in their houses. So there isn't any infrastructure generating an economy there that can repay this loan. I think they have already defaulted quite a while ago.
That's very tragic.
It is.
Very sad news.